Hi, I'm Rochelle, and I'm on a mission to educate everyone about life insurance and how we can use it while we're alive. And a lot of people come to me and they tell me that they really don't understand the differences between the types of insurance. And so I'm just going to preface that and just talk about the different types of life insurance. So there's term life insurance. There's two types of life insurance. There's term and then there's permanent. Term is exactly as it sounds. It lasts a term. And that term can be 10, 15, 20, 25, 30 years. And basically, you're renting that policy. You're renting based on the terms. So it's like renting a house. When you rent a house, you rent it for a term, usually a year. And when that term is up, you have typically the option to renew that lease for a new term, or it terminates and it expires. So a term policy works the same way. So at the end of your term, you typically have the option to renew that term, or it just expires. And the money you're putting into the policy, just like the money you're putting into renting the house, you're never going to see that again. It's just gone. You're renting it. It's not earning anything. It's just gone. Unless you add a return of premium rider to your term policy. And what a return of premium policy does is a return of premium rider does is that it returns the premiums to you if you outlive the policy. So if you have a 30-year policy, at the end of that 30-year term, if you have a return of premium rider, they will return all of the premiums that you paid into the policy. That's great. So term, if you don't have a return of premium rider, all of the money you're paying in is just going to disappear. It's not accumulating, it's not saving, you're just renting that policy. And at the end of that term, you can renew it. However, because you're going to be older, your new rate is most likely going to be a lot higher. Especially if you have a 30-year term, then if you get your policy when you're 30, that means at the end of your term, you will be 60. So because of your age, your premium is going to be a lot higher, whether you are healthy or not, because life insurance is based on your age and gender and your health conditions. So if you developed a health condition over that 30 years, it's going to be also factored in to your new price. If you stayed healthy, your price is still going to be higher. It's going to go higher because of your age. So just keep that in consideration when thinking about a term policy. And a lot of people choose term because it is the cheapest form of insurance. And that is why, is because it doesn't last your whole life. The other type of policy is permanent insurance. So there's whole life insurance, and then there's universal life insurance. So how whole life is exactly as it sounds. Whole life. It lasts your whole life, right? It's permanent insurance. As long as you're paying your premiums, you have this whole life policy. And whole life offers guarantees. So it's a guaranteed premium amount that stays the same throughout the whole term of your life. The rate of return stays the same the entire time, and the death benefit stays the same the entire time. They're all guaranteed. And so the rate of return is for the cash value component attached to that whole value, to that whole life policy. It has a cash accumulation component. So a portion of your premium is going to that cash value account. Universal life is similar to whole life. However, it does not offer the guarantees that whole life offers. And the other difference is that universal life offers flexibility with your premiums and your coverage amount. So with universal life, you have the option of increasing or decreasing your premium amount, or increasing or decreasing your coverage amount as time goes on through the length of the contract. And this also lasts your entire life, usually until you're 120, as long as you're paying the premiums and as long as you're putting enough money into it. Fixed universal life is similar to whole life in that the rate of return is consistent. Index universal life does not have a consistent or guaranteed rate of return. So it's a little bit riskier and less guaranteed on the percentage of the growth you're going to receive in that policy. But universal life, just like whole life, has a cash value component to it. So index universal life also, the difference is it's tied to an index. So based on the performance of those indexes that your account is tied to, that is going to determine the growth of your policy. So that's just the main simplified difference of the two types of insurance. I hope this was helpful and gave a little bit more insight on the differences between term life insurance and permanent life insurance. There's a lot more that goes into all of these policies, and I will talk more about the differences and how they work in future videos. Thank you for watching. Comment below and make sure you follow me for more.